Hello and welcome to the Sisters for Fitness Wellness Show. I'm Stephanie Gaines-Bryant. Our guest today is Constance Nwosu. She's a certified public accountant and she's also the president and CEO of CN Accounting and Management Consulting. Did I get that right?
Yes, you did. Good morning, Stephanie.
Now, you know, everybody's concerned now. It's crunch time.
Yes,
Tax time is just about upon us, just a couple of weeks away.
A couple weeks away. April 17th is the deadline this year.
So it's not the 15th?
Not the 15th. The 15th actually falls on a Sunday, and you know the 16th is the Emancipation Day, and so it's due April 17th this year.
So you got a little bit more time.
A little more time, yes.
So what has changed from this year from the year before?
From 16 to 17, honestly, I've not seen a lot of changes as far as the tax prep, the tax law is concerned. The big change is from 17 to 18.
Okay, and we'll talk about that in a moment. But pretty much this year.
Basically, standard tax returns. You still have your standard deduction, personal exemptions. You still can write off 100% of your charitable contributions, your mortgage interest, 100% of which you pay for your state and local taxes, as well as your real estate taxes. So not a lot of changes from 16 to 17.
Now, President Trump signed the Tax Cuts and Jobs Act last December. What will that mean for the average person? And we've got a lot to go over. So let's start with, does it eliminate the personal exemption?
It does eliminate the personal exemption. However, that's now combined with your standard deduction. So instead of having two deductions, now you have one. As well as with the new standard deduction, it increases the amounts. So for example, for married individuals filing married joint returns, your standard deduction is now $24,000. For head of household filers, it's now $18,000. And for single and all other tax filers, it's now $12,000. So again, the numbers are now combined, as well as they bumped up the amounts for you.
So that makes things easier.
It makes things easier, and also I'm expecting to see one or two filers who've had to file in the past may not have to file this year because the numbers are higher. And remember, our tax is all based on your income. The taxable income really determines whether or not you have to file a tax return. So I'm expecting some of my younger filers, those with their first job, you know, high school kids, they may not have to file because their taxable income may be below the $12,000. Or married filing jointly tax filers, if your taxable income is not at $24,000, again, you may not have to file a tax return. So it may be we may see a few tax filers drop off because of the new limits that are now in place.
This new tax plan basically affects wealthy people or high income people.
High income earners are the ones that I think will more so benefit from the new changes in the tax law.
Now, there's a 37% top rate that will affect individual incomes of $500,000 or higher. What does that mean?
That's correct. One of the things that this new tax law did was it sort of restructured the tax brackets. We still have 7 tax brackets. However, the amounts are now lower. So we have 10, 12, 22, 24, 32, 35, and now 37% tax rate. Whereas before we had 10, 15, 25, 28, 33, 35, and then the highest was 39.6. So still 7 tax brackets, but now the tax brackets are, the amounts are lower.
Does this simplify things?
I don't think it simplifies. I think what it does, it lowers your tax bill, really.
Now, let's talk about the repeal of the Obamacare Care Tax on those without insurance.
That's correct. That's now been repealed. So you no longer, individuals no longer are required to have health insurance. And if you will remember, when that was first put in, you had to have health insurance. You had to either have it through your employer or you had to go out to the marketplace and purchase it. If you did not, then you were penalized when you filed your tax return. Now, starting January 1, 2018, you no longer have to have health insurance. So that's now completely repealed.
And well, of course, you can't say whether that's a good thing or a bad thing.
You really can't. From a tax perspective, I can't. Probably more the medical field would have to answer that question based on, who they see.
And of course, so that means no more penalties. But I'm not sure people were really penalized.
They were penalized. The penalty was added on their tax return. And in 2017, that was a question that I made sure all of my clients was able to answer, and they receive documentation from their employer saying they had health insurance, because if they didn't, I was noticing that tax was being added on the tax return. So it was a real penalty.
Okay, because there were some commentators, some people speaking about that who weren't quite sure whether it was a real penalty. So I'm sure people are quite happy about that.
They will be. They will be, especially those that don't have health insurance or can't afford health insurance. We had a lot of people who were not able to afford health insurance when the mandate was in place. So those individuals will now be happy.
So people in this year saw a little bit of an increase in their pay. Where was that coming from?
Well, that was
people like the increase, but they don't know
you're going to pay for it, right?
Where did this come from?
That's correct. Yes, probably the second pay period in January of 2018. Paychecks started. Folks started seeing a little bit more take-home pay, and that was all part of the president's tax plan. So your income, your take-home pay did go up. Yes.
What changes are we going to see state-wise and locally?
I think state-wise and locally, one of the things that's going to affect us is, there's now a cap on your state and local income taxes that you can claim. The cap is now $10,000. For married filing separate tax filers is now $5,000. So that encompasses your real estate taxes on your home, your state taxes that you pay through your payroll, as well as personal taxes that you may pay. That's now capped at $10,000. And as you said before, it seems as if the tax changes are geared towards the higher income earners. Well, those high income earners who pay more than $10,000 combined in those taxes will not be able to claim as an itemized deduction the amount over that $10,000. So one of the things I'm doing this year when I'm doing the 2017 taxes is providing a 2018 projection based on the new tax changes for my clients. And when I point that out, a lot of clients are really disappointed that they are going to be losing out on, thousands of dollars in additional exemption itemized deductions because their overall state and local taxes is more than $10,000.
But you know what? It's good that you're giving that information because at least people are prepared. They're not shocked.
That's correct. That's correct. And I have to tell you, I've seen folks who are happy because they're lower income earners, and I've seen folks who are not happy because they are higher wage earners. Those who may, have not owed in the past, with the new changes, they're now going to owe taxes. So what I'm trying to do is just to prepare them to, maybe adjust their W-4 exemptions so that they pay a little bit more taxes throughout the year through their payroll versus having a huge tax bill at the end of the year because of the new tax changes.
What about child care credits?
The child care tax credit is increasing. You know, currently the amount is $1,000 for any child under the age of 17. Now that's going up to $2,000. And remember, a lot of the tax changes are temporary, which means that they are in effect for the next 8 years, from January 1, 2018 through December 31, 2025. And that is one of the temporary changes. So you'll get $2,000 per child under the age of 17, as well as anyone under the age of 17 that's a dependent but not your child, you will also get a $500 refundable credit. Again, it's only temporary. Once these tax changes are, you know, once 2025 comes into play, everything reverts back unless Congress does something else.
So everything we've just been discussing.
A lot of what we've just been discussing are all temporary tax changes, yes. Now, if there's one that's been suspended, for example, moving expenses, unless you are a part of the armed forces, have been suspended, which means as of January 1, 2018, if you move for your job or whatever, and if your job does not reimburse that moving expenses, you can no longer take it as a deduction on your tax return. That has been suspended, so that's now a permanent change.
Wow. Yes. A lot of us are worried about retirement. We're approaching retirement. Let's talk about the contributions.
Yes, now you can still deduct 100% of your contributions, and I always advise clients to do it through your employer if you have that option. The maximum amount is still the $18,000. So that means you as an employee can put aside $18,000 of your paycheck to your retirement, which is tax-free until you retire. So that's still a great way to both save on your tax dollars as well as save for your retirement.
How are businesses in our area going to be affected by these? Does this favor business people? Or?
Well, for those that are corporations, I see that to be the biggest savings on their side, because corporate taxes are now capped at 21%, a flat 21% versus the 35% that was in place for many years. So you may recall once the tax bill was passed, there were a lot of companies out there giving out $1,000 bonuses to their employees because they said, hey, now we have more money. And that was the savings from the fact that they would basically be saving 14% in their taxes on their bottom line, going from 35 to 21%. Okay? One of the changes that I think will affect some businesses is that entertainment costs are no longer deductible. And you know, you have a lot of businesses that do entertainment as part of their business development strategy. Whereas before you got a 50% deduction on entertainment, now those are completely gone. No longer can you deduct, you will get a deduction for entertainment expenses. So the tax law was not just for individuals, it also impacted businesses. But I tend to think with the corporations, they will fare out the best.
What about state and local businesses? We've talked about, you know, national corporations, but what about the little folks?
But the little folks, well, on your Schedule C, the Schedule C business owners, sole proprietors, LLCs, S corps, sole proprietors, they will now, well, basically anyone that does not itemize can now get a 20% deduction on their individual taxes from the business. Okay, so that's going to help a lot of individuals to lower their tax bill, because if they have business income, they can deduct 20% of that from their individual tax returns.
What about itemizations?
Itemizations. Now, couple of changes in this area. A few years back, we went from, for medical expenses, we went from the fact that you could only write off your itemized medical deductions if they exceeded 10% of your adjusted gross income, where years before and for a long time it was 7.5. Well, now the 7.5% is back. So in order to write off medical expenses, the amount must be now only 7.5% of your adjusted gross income, whereas before you had the full 10%. Another change is in the mortgage interest area. Mortgage interests, as of written on or before December 15, 2007, the interest that you can write off is capped at $750,000 of a mortgage versus $1 million. So there's changes there. Also, with the new tax changes, you can no longer deduct mortgage interest on your home equity loans. And I see a lot of people with home equity loans where, as before, you could write off that interest as an itemized deduction. That's no longer there. Okay? And another change is the miscellaneous 2% adjusted gross income, where we find in this area you had your unreimbursed employee expenses. I have a number of nurses that are clients, and of course they have to pay for their annual license renewals. Also, you may have someone that travel for business and their employer did not reimburse them. They may use their cell phone for business and was not reimbursed. Well, that's now been suspended. You can no longer write off those miscellaneous deductions that were 2% of your adjusted gross income. So you're going to lose out there.
What about folks working from home?
Again, if your employer does not reimburse you for part of your, internet, cell phone, you will no longer get to deduct that, because that was one of those unreimbursed employee expenses.
All these changes, tax time just stresses people out. Do you find there's a whole psychology behind what happens to people when tax time comes?
I do. I think people get really tense. They get sort of frustrated trying to find the numbers, ensuring that they, get the maximum deduction. Some people try to do it themselves. They get frustrated. They just said, I can't do this. For some reason, it brings hysteria to people. So I do see a lot of people with a lot more stress from January 1st through typically April 15th.
Do you suggest, is it best to do it yourself? Especially there's so many changes that occur, and there's so much you need to know, so many intricate details that you need to know. If you have anything that's more complex than an easy
1040 easy, yes.
Yeah, if you have something more, what is your recommendation with that?
I think that you should seek professional help. Now, if it's just a 1040 easy, you have one job, you may be able just to go on the IRS website, file your tax return free. If it's more complicated, where you have a house, there's mortgage interest, if you're paying back student interest loans, if you're doing charitable contributions, if you may have a side business where you're not only getting a W-2 from your employer, but you're receiving 1099s from those individuals that you provided services to. You may have some rental property. I think you need to consult with a tax professional to give you the guidance that you need. I think it's sort of money well spent. One, because you can ensure that that individual should be up to date on all of the tax changes. Okay? Two, they will be able to advise you on the best way to take maximum deduction for what you have. So I think just consulting or just maybe having a professional prepare your tax return will save you in the long run. And then one thing you don't want to ever do is make a mistake on your tax return. Because,
what happens?
Well, the IRS could come after you. And they may, cite you with penalties for an incorrect tax return. You could also be penalized for taking deductions that were not warranted. So a tax professional can help you ensure that the deductions that you're taking are correct based on the tax rules, as well as you're preparing the tax return on the correct form. They will also hopefully be able, if that return is questioned, to represent you with the IRS under a power of attorney. Maybe they can talk to the IRS to get an understanding for you on what happened and so forth.
What do you think about these electronic programs that help you do your taxes?
I think they're great, but remember, those programs they'll only calculate what you put in. So you have to put the information in correctly in the correct box on the correct line, and then it does the math and it sort of spits out the final return. But you have to ensure that the information that you're putting into those programs is the correct information and that you're placing it in the correct place on those in those programs.
Because it's not going to be their fault if you don't put it in correctly.
It is not their fault, no. You sign your tax return. Even if you do it electronically, you are basically responsible for your own tax return.
That's another thing with having someone to do your taxes. You have a support system there.
That's right. You have a support system. And, even if you're versed in the tax laws, just to be able to ask a question on something that you may just need clarity on is important when you're dealing with tax returns. One, there's a huge liability involved, the payment of taxes. And that's like thousands of dollars for some folks.
You have these pop-up places this time of year. Joe Blow's tax preparation and rib shack.
Right.
How do you know how to choose a good, but what do you look for as far as qualifications?
I think the first thing I would look for is to make sure they're registered with the IRS as a tax preparer. Everyone that's registered with the IRS receives a P10 number, which is a tax preparer ID number. That means you're registered with the IRS to prepare taxes. I think that's like the first thing I would look for if I'm looking for a tax preparer. Hey, are you registered with the IRS? Can I see your P10 number? That's like the basic level of assurance that you're dealing with someone who knows that they at least have to be registered. Also, I would look for someone who's certified, be it a CPA or a certified tax professional. I'd want to be able to talk to them about their education in preparing tax returns. Are you up to date on your CPE credits? When was the last time you've taken a tax preparation course? There would be a dialogue. One, because you're handing over really sensitive information. Two, you're handing over, for a lot of people, your livelihood. As I said, there's a huge financial liability when you're dealing with taxes.
I'm going to bring up the big A word, audit.
Yes, and it's real. It is real. The IRS does come out and audit you. When they look at your tax return, and I'm sure it's all statistics, they probably have these programs that, looking for certain things, and when your tax return doesn't include those things, you probably go into another bucket to say, hey, we might want to check this one out, and then an audit comes up. And when an IRS agent comes in to audit you, they want to see documentation as to how the tax return was prepared. You have to show them creditable receipts, invoices, charitable contribution receipts. They want to see basically all of the documentation that went into all of the deductions that you took.
So in other words, you need to hold on to your receipts.
That's correct, yes. You want to hold on. The statute of limitation is 3 years from the date you file your tax return. basic. Now, if that tax return is under audit, then you want to hold everything until that audit is completed. But yes, I would suggest folks get a file for each tax year, put a copy of the tax return in, as well as all of the supporting documentation from your W-2s, your 1099s, your mortgage interest statements, your receipts for your charitable contributions, canceled checks. Just put everything in a nice, neat pile. Put it away until the statute of limitation ends, and then you're safe, you know, if it's not under audit, to destroy it.
How do you take the fear out of taxes? Because some people, they'll wait, they're going to pass the 17th deadline just out of fear.
Just out of fear, yes. And so I always say, at a minimum, if you're not going to be ready by April 17th, file for an extension. And the extension only gives you time to prepare your tax return. If you think you're going to owe, then by law you need to pay what taxes are due, because otherwise you will be hit with a penalty for failure to pay. So
if you don't owe.
If you don't owe, yes, great. Still file for the extension to give yourself time to get all of your documentation together and to properly prepare your tax return, or to have your tax return properly prepared.
So just do it.
Just do it. You can't get around it. You cannot get around with it, because if you don't prepare a tax return, the likelihood is that the IRS will prepare your tax return for you based on copies of the W-2s and the 1099s and everything else they've received from your employer for you. They'll prepare a tax return for you, giving you the basic deduction, the basic standard deduction. That's it. They'll send you a copy saying, we did not receive a tax return from you, so we've prepared one for you. This is your tax liability. If you agree, sign. If you don't agree, then tell us why. So I have seen times when the IRS has indeed prepared a tax return for a client.
Okay, the next question is, how about if they owe you?
Great. They will give you a refund. However, there's a statute of limitation.
Okay, which
on
is?
Your refund. It's 3 years.
Wow.
3 years, yes.
All these different changes.
Yes.
All of it can be very confusing, it can be very frustrating, and it can be a little scary.
It can be, but it's something you have to do, so
Something you have
just
to
do it.
We've been talking to Constance Nwosu. She is a certified public accountant, and she is also the owner and CEO of CN Accounting and Management Consulting.
Yes.
Thank you so much for joining us today. You've been watching the Sisters for Fitness Wellness Show, and this is a wellness issue. You got to do it.
You have to do it, and your financial wellness cannot be. You want to be financially well off.
Yes, indeed, you do.
Yes.
I'm Stephanie Gaines-Bryant. Have a great day.